such a pleasure to be joining you right here on the India Development Debate on ET Now. I'm Supriya Shrinate, and tonight we'll be discussing two big issues. One, of course, macros, and are they worsening, and is the falling rupee a big sign of that? And at 9:30 p.m, we'll put the spotlight on Chanda Kochar and her election as a board member on ICICI Securities. But first up, we scan the macros. The fault lines in the economy are only getting deeper with each passing day, it seems. The rupee, which plunged to a new all-time low today, is the biggest casualty, even as the widening current account deficit and the fiscal deficit are posing new risks to the macros. And with fuel prices touching new highs every day, is it a raw deal for the common man? Remember, the spike in fuel prices will have a recoil effect on inflation, which is already rolling above the RBI's comfort levels. The bad loan menace is another big problem which has already pushed several power companies to the brink. Looks like the economy is gasping for breath, taking a heavy toll on the confidence level of industry and investors. The fault lines on the macro front is the big topic of discussion and debate right here on the India Development Debate tonight. And I've got a stellar panel right here to discuss the macros with us. R. Gopalan, former Secretary of Finance and also former Secretary, Department of Economic Affairs. I've got Dr. Germany Bhagwati, former Ambassador and RBI Chair Professor at ICRIER, making his debut tonight on India Tonight. Shagata Bhattacharya, Chief Economist at Axis Bank, and our very own consulting editor, Maithili Bhusnurmat. So thanks each one of you for being with us. And it's only fair that I begin with the rupee. Let me start with you, Mr. Gopalan. Rupee touched a new low of 70.85, closed at over levels of 70.70, precariously close to the 71 level mark. Is that the new range of our currency, or is this simply on account of the high trade deficit and higher oil prices?
There are a combination of factors. Trade deficit is one factor which contributes to the value of the rupee, but there are other activities going on outside where the EME currencies are facing a bit of a problem, as we see. We have other issues, dollar strengthening, you have got oil price increase, and all these factors are contributing to the weakening of the rupee. Maybe there are certain immediate proximate factors like the corporates who did not hedge their currencies, I mean the rupees, they are now coming in droves to hedge them at this point in time, and FPA outflows also contributing to demand on dollars, and these are probably ganging up together to have an effect on the rupee.
Fair point. Just hold your thoughts there, because I'm going to take this across to Dr. Bhagwati as well. And, you know, when the rupee falls, and especially today, there is an obvious and immediate parallel that's drawn between a relentless fall that's happening now versus the carnage that one did see in 2013. But the reality also is, apart from the global factors and the strengthening dollar, India is in a definitely better shape macroeconomically speaking. Fiscal deficit is at 3.5% versus 4.1 then. Inflation has halved to 4.5 versus 10% then. CAD is likely to rise to 2.6, but that is still lower than 4.7 back in 2013. Now, these are clearly strong macros. What then accounts for this persistent weakness, and what does this say about our fundamentals? Are those fundamentals worsening? And are these factors enough to brace up for the global currency carnage? Are they going to be sufficient, really? Dr. Bhagwati.
Okay, thank you for having me on your show. First of all, I would agree with you that the macros are sound. So I won't repeat all the macros because you've already mentioned all of them. But your question was, given the fact that the macros are fairly sound and there is nothing dramatic happening on the trade front or even on the China-US trade front, nothing more is happening, why is the rupee slipping? It's more like water accumulating behind the wall of a dam. If you do not take action, as some say was not taken properly in the case of the floods in Kerala, then you have trouble. I'm not suggesting that we are about to see the same kind of flooding in the sense of the rupee sharply going down vis-a-vis the dollar in nominal terms. But have a look at the RBI's latest report, which mentions that the rupee is heavily overvalued. If you look at the real effective exchange rate against 6 currencies, the major 6 currencies, the rupee is something like 25% overvalued even now. So if you have systematically high interest rates, both nominal and real in India, compared to the US, I won't get into all the other currencies. Let's take the 3-month Indian Treasury bill rate. That's about 6.8%. Look at the comparable US government 3-month Treasury bill rate. By the way, these are annual numbers, annualized interest rates. That's about 2.11. We're talking about a difference of 4.7%, and I can give you the numbers for the 10-year rates and so on. And you can, you will see that we have systematically avoided allowing the rupee to correct over the last at least 5, if not 10 years. So when you allow the rupee to get so overvalued, I'm not getting into all the stuff about how it hurts exporters and so on, and whether now the rupee slipping will lead to higher inflation. It will to some extent, but I am always surprised when some people say that our imports of oil will get more expensive. They won't, for the simple reason that we buy our oil in dollars, not converting rupees into dollars, but whatever dollars we have in our reserves. I'll stop there. I could explain further, but I thought I'll stop there unless you have a specific question about what I have already said.
No, I will come back to you. Yes, I will come back to you because rupee is not the only thing that we're talking about. We're discussing macros in general, and I'm going to come back to you in just a minute from now. But before I go any further, Maithili, I want to come to you. The reality is that RBI is in the market defending the rupee. At 70-80 was in the market. People thought RBI was in the market at 70-60 also. Should the RBI be doing that? Should forex reserves be used to defend a currency that's not actually a controlled currency? Or should it be left to market forces to handle the rupee as it were? I mean, people may say that we've got great forex reserves, but we've also seen those forex reserves deplete by about $25 billion in just a period of 2.5 to 3 months. Is that a wise call to make?
Well, the RBI, as is common with central banks of all emerging market countries and even some of the developed countries for that matter, always intervenes when they feel that the movement is too sharp. So what the RBI has been doing in the process of intervention is to ensure that the depreciation is gradual and is not too dramatic. So that's what the RBI has been doing for the past, in fact, a couple of weeks. And if you look at it, Supriya, in fact, it's interesting that August seems to be a particularly cruel month. In 2013 also, the rupee touches low, then it was 68.85 on August 28th. Today we have touched on August 30th, the lowest that we're seeing this year. So I think it is a combination of factors, and yes, it's true, our macro fundamentals are much better. And given the fact that we have over 400 billion of reserves, I think 25 billion is not a very large amount to spend, because this is a classic response of all central banks in the initial stages. Then of course, if it doesn't work, then they step in with other measures like interest rate defenses, capital controls.
I think there's a problem with Maithili's. I think there's a problem with Maithili's video. We will go back to her. Please connect her as quickly as you can, because I do want to go back to Maithili and get her perspective on this. But turning to the other concern area that seems to be also playing in on the rupee is a sign of a worsening twin deficit. And Shaukato, coming to you, let's bring in the fiscal deficit first, especially after both the RBI red flagged it and of course then the Moody's warning that came yesterday. Moody's insists, and I'm going to just quote them here, that higher than budgeted oil prices and the cuts in GST on many items and higher MSP will widen the deficit. Is India's fiscal situation right now one that is perhaps going to be a little more precarious going forward?
Well, I mean, till now, it doesn't look as if it's completely out of control. There are signs of some slippages. Borrowings are relatively higher, front-loaded again at this point in time. tax collections probably are not that as buoyant and robust as we had earlier expected in the day. But to the government's credit, the centre particularly, I think the fisc is not that big a problem as of this point in time. Obviously, I mean, there are concerns because the way interest rates, the rates on G-Secs and state bonds have risen, there is definitely concern about, particularly in an election year, if there is some slippage in fiscal discipline, that's a problem. But I think more than the fiscal, I think the immediate problem at this point in time, which is of course a mirror image of the fisc, because I mean the excess demand that is coming in from the fisc is obviously what is showing up in the current account deficit. But the immediate problem now is the current account deficit, because and this is a one-to-one function almost on oil and besides oil, other electronics imports. So this is the problem. If I could just switch you from the fiscal deficit to the current account deficit, a telling statistic. Last year, the current account deficit was of around $47 billion, and we got $22 billion.
Shagata, why don't you let me come in there? Shagata, if you can let me come in there. Okay. Shagata, if you can let me come in there. Shagata, just a minute. If you can let me come in there, I will touch upon CAD in a minute from now. Just want to get done with fisc because I don't want the debate to be pulled in another direction. Just give me a minute. Bear with me. I'm coming back to you on CAD in a while. But you made an important point that in an election year, we will have to see how prudent the government can be. And Mr. Gopalan, the alternate argument on fisc always is that, you know, private sector investment at least seems to be picking up. And as private sector find its mojo back, the government will be able to cut back on spending. Now, you've been a career bureaucrat. How easy is it going to be to bring in fiscal prudence when you're 10 to 8 months to 9 months away from general elections? And that is perhaps going to be the test of fiscal prudence right then.
Well, on the eve of elections, always there is a tendency for the fisc to slip a bit. The government, at least at this point in time, seems to be totally alive to the difficulties the fisc slipping can cause to countries' rating, the exchange rate and other macros. So my considered opinion at this point in time is there will be some slippage, there will be a tendency to do some slippage, but there will be a greater attempt to see that the slippage is, if it happens at all, it can be only very marginal and nothing more than that. But this is once again, if you are not buffeted by other shocks, external shocks that can happen. So that is what I think will be the situation as we go along towards May 2019.
Well, that's an important point that you make, that fiscal slippage of a very minor kind, perhaps the markets will also be budgeting and will be forgiving. A large fiscal slippage is something that they will be very unforgiving for. But to be fair to this government, they have at least been very prudent as far as maintaining that stability is concerned. But coming to you, Dr. Bhagwati, how prepared is India at this stage to handle the complete unwinding of the unconventional monetary policy that we've seen around the world, particularly the Fed, also a possible correction in the US stock markets where rates could go up, and a further strengthening dollar? And all of that obviously has a bearing on an implication on which way the rupee heads.
I don't think we are that badly placed. As has already been mentioned, we have a substantial amount of foreign exchange reserves as long as we don't fritter them away in trying to defend the rupee. You must have seen that the US Fed has already indicated that they are probably going to raise rates by another 25 basis points at the next meeting of the FOMC. That will gradually, as rates keep rising in the US, unless of course for reasons of their own in the US that they are close to full employment anyway, and yet if inflation doesn't pick up, the US Fed may not raise rates. So from that perspective, I think there is danger, but it is not something that I would be very concerned about. What we need to be more concerned about is how do we manage a gradual sliding of the rupee to more what I would consider reasonable levels, given the fact that we have not taken the action in the past to allow the rupee to slide. Every now and then we have defended the rupee, and that unfortunately has created the situation. Now, there are wider issues here in terms of our trade deficit in terms of our goods trade. Those issues cannot be sorted out over a year or two. There are issues of competitiveness and so on. So I suppose one can break it up into short-term, medium-term and long-term steps that government should take. In the short term, please do not defend the rupee unless, as was I think mentioned by Maithili, the reduction in the value of the rupee is dramatic. And there too look for other ways rather than frittering away our foreign exchange reserves. That's in terms of the short term. In the medium term,
Fair point.
One needs to look at our export promotion schemes and what we do in terms of our value chains and so on. In the really long term, it goes back to the fisc. But actually, I think there is perhaps overemphasis and over scrutiny of the fiscal deficit. What we should be doing is looking more closely at the primary deficit, that is just government expenditure and government revenues, even before interest payments are taken into account.
Dr. Bhagwati, I'll have to come in there.
If we do these three things over these 3 time frames, I think we should be okay.
Okay, so don't waste your reserves to fritter away the rupee right now. But let me go back to Shaugato. And Shaugato, you were making the point about trade data. I promised to come back to you. The July trade data, of course, throws up big concerns. Yes, higher oil price is a big factor for the $171 billion trade deficit between April and July. But so is the nearly 11% rise that one is seeing in non-oil and non-gold imports that you were also alluding to. We seem to be fretting over the wrong issue here, aren't we? And do you believe at this stage there is some sort of a policy intervention that's required on that non-oil and non-gold imports?
Yeah, I think you are 100% right on this, that as of today, I think what happened in when oil prices came down is that expenditure switched to other forms, electronic imports, imports of mobile phones, etc. And now that oil prices have risen, and our oil import bill has risen, the other items have not come down. So the elasticity has not switched between these commodities. The government is taking steps. I mean, the new factory of mobile phones in near Delhi, say for instance, the drive to bring in, indigenize as much as possible. I mean, some customs duties on the import component, but even now there are significant problems. Inverted duty structures in many items which encourage actual imports of fully produced commodities, etc. I think these are the steps that now need to be taken to try to stem the other imports and even oil. I know this will be an incredibly unpopular decision to try to impose some cess on oil, because unfortunately, even with the higher oil prices, oil consumption still is growing at a fairly good pace, 6%, 7% in a year. So that doesn't seem to have worked. You know, so and unfortunately, I mean, the last year.
But Shaugato, no, you're actually pointing me to a question on oil, and I think it's only fair I go to Maithili on this. Maithili, oil is on the rise all over again, and you know, I think Shaugato is giving me an economist's answer when he says there could be a case for a cess. There is such a clamor for an oil price cut. You know, there is such a clamor for those excise duty cuts that we've been talking about. And, you know, with everybody clamoring for this, I wonder if in an election year, the government can go ahead and put any cess. I think it's going to be politically suicidal. But even then, the oil prices have ballooned, and this has stoked fresh fears on inflation. It clearly won't just be about reining in prices anymore, because this has a direct impact on the trajectory of the rupee as well. You know, oil from being a tailwind is going to be a headwind. I'm just interested in knowing on how big a headwind could oil be.
Oh, well, it all depends on how oil prices pan out going into the future. It could become an enormous headwind because remember, we import almost 80% of our oil requirements, and in an election year, it becomes very difficult for the government to hold firm. It's shown, in fact, extraordinary courage so far by ensuring that it passes on the oil price hikes, but one doesn't know how long it will be able to stay that way because it's going to be tested very severely if oil prices continue to rise. Remember, we also have to kind of wean away from the imports from Iran, and that's going to be very difficult because that will kick in soon. And though we've been asking the US for an exemption, it's not very clear we will get that exemption. And if we have to revert to other sources, we might have to pay a higher price even apart from the Asian premium. So clearly, oil prices are going to test the government in every which way.
Interesting point that you make there. I mean, not just the Iran exemption and, you know, Iran is willing to offer you a lower price. And how do you walk away from a deal like that? US is perhaps unwavering even on the waiver sanctions as far as buying weapons from Russia are concerned. But very quickly, Mr. Gopalan, coming to you, S&P was in North Block today. You've conducted many such meetings for an official review of our ratings. In November 2017, they maintained BBB minus, gave us a stable outlook, but specified that robust foreign exchange reserves must rise further. That may have not happened, but the reality is that from 2017 November to August 2018, how are factors stacked as far as our ratings position is concerned? We got lucky with Moody's, but what about the rest?
Can you repeat the question? I had some audio problem. Can you repeat the question?
Right. I'm just saying S&P was in India at North Block for a review of our ratings. How do the macros stack up as far as our ratings is concerned? Moody's, that had upgraded us, today talks about and raises a red flag on the fisc.
You see, our problem on rating agencies has been, we have been interacting with them quite frequently. They look at the entire macro picture, but they also are placing more emphasis on what is the debt levels in the country and debt to GDP. That is something they seem to feel that it is on the high side, and therefore, for comparative performance on other parameters, they don't seem to give that kind of a weightage to India because of these factors. They are also a little worried about the effect, or what is the government's, commitment to stay the course in the fisc. That is also another point of difficulty they have. And thirdly, about the exchange, how the exchange rate can impact our economy, that is always at the back of their mind. But my feeling is that, we can't expect any upgrade at this point in time, given the pressures on the macros and with the external environment being what it is. At this point in time, we cannot expect any upgrade. That's for sure. As far as export is concerned, I would like to also take this opportunity.
I'm sorry, I'll have to come in there. Completely running.
Exports.
No, completely running out of time here, sir. My apologies there, but I'm running out of time. I'll give a quick word to Dr. Bhagwati. I'm sorry, sir, but I'm really running out of time here. My sincerest apologies. Dr. Bhagwati, very quickly, and if you can keep it short, in an election year, does India really run the risk of an overheated economy on account of higher spending, which could mean higher inflation, wider deficits, all of which directly puts unrelenting pressure on the rupee all over again?
No, even in an election year, as far as I can make out till now, the government has been quite responsible. So obviously I can't say exactly how the Finance Ministry and the Government of India will view spending in terms of the impact on elections next year. That is something which I don't know about. But to date, for the last 4 years, I haven't seen any indication from the government that they are not mindful of the deficit numbers. And I think the government has several avenues by which we don't have time, as you said, to look to raise revenues, and more importantly, also to cut expenditures, particularly the non-capital expenditures. And finally, I think the point was made about how any oil price rise is, oil price meaning at the pump, is very unpopular. But I think if you compare the prices of petrol at the pump in India and in Europe, you will find that the prices in Europe are higher for the average person, and their per capita incomes are much higher than ours. So, with due apologies to the Indian population, I think there is some room there for government to raise petrol prices rather than reduce them.
Right. Dr. Bhagwati, I think it's a very, very politically sensitive issue that you're giving some sound economic advice on. But I wonder if any government, yes, but I think any government is not going to be taking that call, not before elections. But thank you very, very much, Dr. Bhagwati, Mr. Gopalan, Maithili Busturmat and Shagata Bhattacharya for being with us. Maithili, of course, continues because we come back with the second edition of the India Development Debate, because we put the spotlight on ICICI Securities, the announcement of Chanda Kochar on the board. But for now, the slate has been laid out. India's fiscal position and the CAD seems to be areas of concern. The rupee in a relentless fall, and all of that on the back of global factors that aren't helping us either. We take a breather. We are back in a moment.